Creased shirt, check. Bags under my eyes, check. Messy haircut, let's go. In this video, I'm going to analyse Tsco/Tesco stock by giving my thoughts on the business and whether you should buy Tesco right now. Next week, I will be covering Rolls-Royce, so please drop me one of these to support the series. Tesco plc is a grocery retailer operating in the supermarket industry. They also provide banking and insurance services. Tesco were a global brand, but a few years back they decided to cut back on their operations so that they can focus primarily on the ones that are most profitable. Most recently, this means they have they're in the process of selling their Thailand/Malaysia branches, and so at the moment they are only exposed to the UK, Ireland, Slovakia, Czech Republic, Hungary and Poland. They're listed in the FTSE 100, have 405,000 employees and have a market capitalisation of £20 billion. Tesco is in an oligopoly market structure, which basically means that more than 5 of the competitors in this take up 50% of the total market share. This means that competition is quite fierce and it is quite hard for them to claw market share away from each other. Neither brand has too much of an advantage over another, for example. However, to say the least, Tesco are the market leaders in both their grocery retailing and also petrol retailing, in which they're actually ahead of BP and Shell. The biggest issue with oligopoly is that the way to gain market share would be by reducing prices. But what would happen is if one company reduces prices, all the others will follow, and therefore you kind of lose out on the bonus but lose more profits. So it's a very fierce competition and you've really got to calculate what to reduce and what not to. It's probably very likely we see a lot of yellow labels and many different branding deals for like promotions at supermarkets, so they can try and squeeze deals but then put it back up. So Tesco is competing with Aldi, Lidl, the discounters. You've also got the standard supermarkets like Asda, Sainsbury's, Iceland. I'm not going to go into all of them, but they're also competing with Ocado, which only have a market share of 1.6%, but they have the potential to really take this away. Furthermore, they're also competing with BP and Shell, like I mentioned earlier, in the petrol retailing. And I'm not going to go into the bank and insurance sector, as recently in 2019 they actually sold their mortgage book to Lloyds, and so I suspect they're slowly winding this sector down so that they can release capital from it and therefore reinvest that money elsewhere. It's worth noting that they are the market leaders in the grocery retailing with a 26.9% market share and in the petrol retailing with a 15.9% market share. So when looking at investor sentiment of Tesco, we can see that it's actually quite low. Whilst their price to earnings ratio is higher than the market, it's still lower than the industry, which tells me that investors aren't as bullish on this company as perhaps other firms in the industry. Furthermore, this isn't actually backed up by the price to book ratio, which actually tells us that they are more overvalued comparing their assets to the market capitalization, although I suspect this could be a hint that they have a lot of debt. I suspect that investors have priced down Tesco's simply because over the last 5 years they have had a declining market share versus that of Aldi and Lidl, the discounter stores, which are really shaking up the industry. If we look at the earnings growth for the last 5 years, it looks fantastic. However, we should really look deeper into this. Firstly, it's worth noting that since they have been selling their global assets, such as, for example, their Thailand, Malaysia, this is going to temporarily increase their earnings. Therefore, this could be much more inflated than it actually is. And if we look deeper into it, in 2015 they actually marked a £6.4 billion loss, in which 4.7 billion of that was actually marked from property value falling, which I believe that they actually used to therefore, in pre-tax losses, to therefore write off tax, although I'm not entirely sure on this process, but that's what I think they may have done. Regardless, this means that their earnings growth looks overinflated. Regardless, what we can do is check the management's effectiveness and how well placed Tesco is as a business. First thing we can look at is return on shareholders' equity, which is actually lower than the industry and a trend that also follows for return on assets. I suspect that this is because they have whilst they are profitable, they have very low profit margins. Therefore, they need to invest a lot of capital or shareholder equity in order to generate profits, and therefore they're going to have lower returns than the smaller peers in their industry. Although I believe that this is very much the cost of the industry and the oligopoly market structure. As I mentioned earlier, if they lower prices or raise prices, or for example, if they do raise prices, what will happen is they'll end up losing market share, so they can't really be extremely profitable in that regard. So I don't think the value is in growth of this investment, but rather perhaps it's more leaned towards dividend income. And I think dividends is where Tesco really shines, and if you're interested in getting a free share on Trading 212, simply deposit £1 using my link in the description down below to get a free share worth up to £100. Tesco currently has a dividend yield of 4.61%. They have a biannual dividend payment which pays in July and November each year. They, in the history or the last 20 years of dividend payments, have been a pretty good dividend payer. Obviously in 2015 they had to cut and suspend their dividend because of that marked loss making, and at that point Tesco were very much struggling. Regardless, but prior to that point, Tesco were such an excellent, reliable dividend growth income stock, and honestly there's not much more you could really ask for. So presuming that they do resume to this stage, this could be a winner. Currently Tesco have a payout ratio of 86%, which is very much on the high side. This suggests a lot of risk, especially when accounting for that high dividend yield, although I kind of understand it as they are a fairly mature business, and obviously they are selling off their global assets, so they can add that back as shareholder value, as typically reinvesting those earnings back into the business, as we saw earlier with the return on equity, return on assets, it wasn't that great, so providing shareholder value is likely the best option for them. However, as I said earlier, a high dividend yield combined with a high payout ratio could lead to a very risky dividend. So how is the quality of their balance sheet so that we can check if they are easily able to sustain it? Well, when we look at their balance sheet, it's an okay but not great balance sheet. This is because their short-term assets do not outweigh their short-term liabilities or their long-term liabilities, although it's fairly close and they do have a lot of long-term assets. Furthermore, when we look at their debt-to-equity ratio over the last 5 years, it has very much been reducing, and that is a positive trend and excellent to see, but also at the same time it is still fairly high at roughly 60% at the moment. Although when we do see their cash position, which is £2.5 billion, it is approximately 1/3 of the debt and is certainly a significant sum to have in cash. There are some risks and red flags with the investment of Tesco. Firstly, they are in a very competitive industry and they have been steadily losing market share over the last decade due to the likes of Aldi, Lidl and Ocado. Although Ocado not so much, but I suspect over the further long term that they will be a significant threat. Regardless, as it is a competitive industry, it's not like you're really going to be seeing much growth in market share in your investments, and rather you would be looking to see how well Tesco can preserve their market share and slightly grow it. They're not really a disrupting business like Aldi and Lidl or even Ocado are, so they've really got to adapt their strategies in order to survive. Another concern is whilst in the last few years they have been growing their dividend by around 90 to 60% in terms of trying to get it back up to where it is, at this current dividend growth it is completely unsustainable and likely to very much slow down. I suspect next year it might be half to 30%, especially combined with this high payout ratio. It does give me the idea that the dividend could be at risk if they are not smart with managing it. Although I suspect that once they get to a level where they are satisfied, they'll start steadily growing it and provide a new base for the dividend growth, which could be good for dividend investors. On the other hand, compared to the other competitors in this niche, they were by far the most prepared for the pandemic. Aldi and Lidl didn't have any delivery systems, and I believe that currently the temporary fix to it was using Deliveroo or one of those Uber Eats kind of things, and that they had to use these in order to deliver their shopping. Tesco's already had a large delivery fleet, warehouses in many locations, and were easily able to acquire these deliveries, and in fact they had to bolster the delivery slots in order to make sure they could supply the demand. And so this does give me some positive appeal towards Tesco's management, as they were ready for this. Even though no one could have anticipated the pandemic, they were the first to enable social distancing and have a successful delivery fleet. If they're able to keep ahead of the trend, then no doubt I can imagine they'll stay market leaders, and whilst it doesn't look too great at the moment, I reckon they could turn this reversing shareholder trend or share trend and actually reverse it the other way and start to slowly grow and be a defensive, reliable dividend investment. And if you'd have bought Tesco in the last 5 years, you would have gotten returns of 29.3% with dividends reinvested, which does beat the market and I believe the industry. Although it's not impressive, but we do need to remember that in 2015, that's where they marked that big loss, and therefore there was quite a significant reduction in share price. Regardless, I feel that this is an excellent stock for a person looking for a lower volatility, defensive but reliable dividend income stock for their portfolios. So perhaps those that are in retirement or very near to it, if you really need that dividend income, then Tesco is likely a good one for you. I very likely suspect that this will not be a repeat of 2015 where they dramatically cut and mark huge losses. I think they're on quite a transformative stage, and therefore once they can reverse this trend, it could certainly be more bright. Although on the downside, they do have very low profit margins, which aren't really great for me, and it's hard for them to grow their earnings organically. They have to use more inorganic routes. Perhaps they'll have to acquire other businesses, which there aren't too many valuable businesses that they could acquire in the UK or in the Europe, so I'm not too sure. As for myself, I really like Tesco, and whilst I'm not going to be adding it to my investment ISA, if I were to be creating a dividend income portfolio that had a UK domestic base, I would very much add Tesco to it. Whilst yes, shareholder returns haven't been great in the last few years, I suspect this trend will end, as I've mentioned earlier, and therefore I would likely add it to a portfolio of that kind. However, currently my investment ISA is based on very high dividend growth stocks that not only have a dividend payment but have a very high chance of being able to appreciate in capital value. Tesco doesn't quite have that, and you will likely be battling against investor sentiment, which could prove more difficult. And it's never great to see a business sell off portions or their subsidiaries, but if they are able to focus on what's most profitable, really cut down on those areas where they aren't making much, and really focus on these areas, then I feel that they could definitely turn this around and be an excellent investment for shareholders. And if there is a long-term opportunity, perhaps now is the time for investors. If you're interested in my Barclays stock analysis, then click the card at the top right of the video. Thank you for watching. I'm Osborne Creasman. Have a great day.